Here's a number that should bother you. Every popular indicator on your chart, RSI, moving averages, MACD, Bollinger Bands, is built from one input, past price. Not order flow, not news, not what the big desks are about to do, just the prices you can already see. And yet traders treat these tools like weather forecasts. Before we go further, this is educational commentary, not personalized financial advice. What I want to give you today isn't a signal. It's a mental model that will change how you read every chart you ever open again. Let's name the wrong belief out loud because you've probably held it. The belief is, when RSI drops to 30, the market is oversold, so a bounce is coming. When the 50-day crosses above the 200-day, a new uptrend is starting. In this story, the indicator knows something. It's a leading signal. It predicts. Hold that belief in your head because we're going to run it into a wall in about 90 seconds. Take the simplest indicator that exists, a moving average. The 10-day moving average is nothing more than the average of the last 10 closing prices. That's the entire recipe. Add 10 numbers, divide by 10. So ask yourself the honest question. If I hand you the average of the last 10 days, does that tell you tomorrow's price? Of course not. It's a summary of what already happened. It's arithmetic on history. The average can't contain information that the prices themselves didn't already give you. Here's the aha sentence I want you to keep. Every indicator is just price wearing a costume. RSI is price, risk-scaled between 0 and 100. MACD is one moving average minus another, price minus price. Bollinger Bands are a moving average plus a measure of how much price recently wiggled. None of them add a new variable from outside the chart. They take the same past prices and repackage them into a shape that's easier for your eye to read. That's genuinely useful. But it is description, not prediction. Now let's kill the oversold myth with a concrete case. People say RSI below 30 means a bounce. But RSI is a ratio of recent up moves to recent down moves. When RSI hits 30, all it's telling you is that price has been falling harder than it's been rising recently. That's not a coiled spring. In a strong downtrend, RSI can sit under 30 for weeks while the stock keeps bleeding. A falling knife has a low RSI the entire way down. The indicator isn't broken. You just asked a rear-view mirror to see around the corner. The same trap lives inside the golden cross. When the 50-day moving average crosses above the 200-day, traders call it the start of a bull market. But think about what a moving average actually is, a delayed echo. The 200-day average includes prices from over half a year ago. By the time a slow average crosses a slower one, the move that caused it already happened, often weeks or months earlier. The cross isn't the ignition. It's the smoke that appears long after the fire started. So if indicators can't predict, why do so many people swear they work? Two reasons, and both are about you, not the market. First, hindsight. Pull up any chart mark where RSI hit 30 and you'll find bounces near some of them. Your eye deletes the 20 times it failed and frames the 3 times it worked. That's not analysis. That's a highlight reel your brain edits for you. Second, and this is subtle, some indicators appear to work because they're self-fulfilling in the short run. Enough traders watch the 200-day moving average that orders cluster around it. So price sometimes reacts there, not because the average has power, but because a crowd agreed to treat the same number as important. That's a real, tradable effect. But notice what it is. It's behavior, not prophecy. And a crowd's agreement can dissolve the moment a bigger force, earnings, rates, a Fed surprise, walks into the room. Here's the reframe that makes indicators genuinely valuable again. Stop asking an indicator to tell you the future. Start asking it to describe the present cleanly. RSI doesn't predict a reversal, but it does measure momentum in one honest number. A moving average doesn't call a top, but it does define, objectively, whether price is above or below its recent center. Volatility bands don't forecast the next candle, but they tell you how stretched the recent range is. Description you can act on, prediction you cannot buy. Let me make that concrete with position sizing because that's where this actually saves money. Suppose RSI and price both show momentum has stalled and volatility just expanded. That doesn't tell you which way price goes next, but it does tell you the range of outcomes just got wider. A disciplined trader reads that as, my stop needs more room, so my position needs to be smaller to keep the dollar risk fixed. The indicator informed the size of the bet, not the direction of the bet. That's the correct use. Compare that to how indicators get used in the wild. A trader sees RSI at 28, decides the bottom is in, and buys with full size because the tool feels certain. There's no plan for being wrong because the indicator supposedly removed the uncertainty. That's the exact setup that blows up accounts. The false confidence isn't in the market. It's borrowed from a number that was only ever summarizing the past. Certainty is the most expensive thing an indicator can sell you. So here's what a disciplined trader actually does. 1. Treat every indicator as a description of what already happened, never a promise of what's next. 2. Never take a signal without a plan for it being wrong because a rearview mirror can't set your stop. 3. Use indicators to standardize your read. Is momentum up or down? Is volatility high or low? And let your risk model, not the indicator, decide how much you bet. The edge was never in the indicator. It's in what you do with the honest picture it gives you. And this model travels. It's true of chart indicators, and it's just as true of the economic dashboards everyone quotes: unemployment, CPI, earnings multiples. They measure the past with confidence and imply the future with none. The next time an indicator makes you feel certain, say the handle back to yourself. It's just price wearing a costume. That one sentence will keep you humble at the exact moment overconfidence gets expensive. If breakdowns like this sharpen how you trade, subscribe. We do signal, not hype. I'll see you in the next one.